Three Stocks I'm Buying January 2020 edition. Welcome in, guys, to the first episode of 2020. Three Stocks I'm Buying January 2020. This is my favorite series I do on this channel each and every month, where I go into three stocks that I am planning on buying in the upcoming month obviously being January of 2020. And as always, I hope you guys really enjoyed today's video. Make sure you smash the thumbs up button if you enjoy these videos each and every month, and let me know what your opinion is on the comment section of these particular stocks, and if there are any stocks that you are buying in January 2020, let me know in that comment section. By the way, guys, we got the sickest deal ever going on here today. I wanted to go ahead and start the New Year's with a smash, and we are doing a sick deal here today to get in my private stock market membership group. It is by far the best deal we've ever done, and it is the best deal we will ever do, okay? Today's deal will be the pinned comment down there. You can get in for $444 here today. It's usually $1,200 if you want to get in that group on a yearly basis. So $444, that covers you for an entire year. And that allows you to learn directly from me, as well as be part of the Discord chat, where you can chat with not only myself, but also a ton of other experienced investors. We have over 600 members in that group now. And we have members from all walks of life, different amounts of money. I mean, some people in there are working on their first $10,000 in the market. Some people in there have millions in the market. Now, once you go ahead and get in the group, go to course curriculum and get in the Discord chat immediately. And in that Discord chat, we have many different chat categories in there, the main one being the stock talk, okay? But we also have subcategories: Uber stock, Tesla stock, macroeconomic talk. We have a ton of subchats in there, but get in the Discord as soon as you get in there. From there, go ahead and scroll down in course curriculum and check out the Stock Market Investing Mastery 11-part course in there. That's in the course curriculum. You just have to scroll down a bit. Then check out the Dividend Investing Mastery section. Do not worry about the 12-part Stock Options Mastery course in there unless you've been in the market a long time. I put that course together just so all the members can view that and learn different option strategies in case they're interested. I'd rather have them learn the risk and rewards with those different option strategies rather than get somebody else's course who doesn't really explain the risk going in with a lot of those option strategies. So don't check out that unless you're super experienced in the market. From there, just start going through all the old curriculum, starting with the December 2019 videos, going from November 2019, and just work your way down. There are hundreds of videos to learn from in there. Looking forward to having as many of you guys in that group as possible. I would love to see us get to about 1,000 members in 2020 and make that really like the strongest group of investors really in the world that you'll ever find, okay? Let's start getting this, guys. Stock number one up here is good old Facebook stock. This is a $204 stock, ticker symbol FB. And to show you how much I really believe in this stock, we're up over 33% on our current position on Facebook. Two of these stocks I haven't started buying, but this one I have already started buying. I started buying this one like a year and a half ago, and we've done amazing on it. Over a 33% gain, like in the public account alone, we're up nearly $19,000. And so I rarely buy stocks that I'm up 30+% on, but Facebook is still so undervalued that I have to buy more of these shares. We're looking at a company here in 2020 that should grow somewhere around 22%. I wouldn't be surprised if they actually grow a little faster than 22%. So expected to do about $85.7 billion. That's what analysts are expecting as far as revenue goes. I think that will be easily beatable. In terms of forward P, it's only a 22 on Facebook, which I think is way too low. If you compare them to their peers, like a Google, that one's trading at a 24.5. And keep in mind, Facebook will well outgrow Google's earnings per share over the next 5 years. I don't even think we'll be close between those two companies. Same exact thing with Microsoft. Microsoft's trading at a 26 forward PE. And Facebook's earnings growth over the next 5 years will crush what Microsoft does. Same exact thing with Amazon. Amazon's trading at a 68. And even in Amazon's case, I believe that Facebook will outgrow Amazon's earnings over the next 5 years. So if you're looking at big cap mega tech, right? You're looking at these different companies, you're wondering who's the most undervalued of the bunch. In my opinion, by far, it's Facebook, because this is a company that will be able to grow 20% plus as far as their revenues go for years to go in the future. And their earnings per share will increase at even a more substantial rate, and they'll well outgrow these other companies that are trading at premiums to Facebook. And I just don't think that is right at all, okay? You're looking at a company here, as far as the balance sheet goes, you guys know I love a great balance sheet. And oh my goodness, does Facebook have it? I mean, over $52 billion in cash and short-term investments. At the end of this quarter, when we see the results coming out in January at some point here in 2020, they should have around $60 billion, if not more than $60 billion sitting around in cash and investments on that balance sheet, and pretty much non-existent debt. That is an unbelievable balance sheet, and that allows the company to do a lot of different things as far as acquisitions down the road, or just keep the money for a rainy day, pay out dividends down the road, whatever they want to do. The bottom line is the cash stacks are getting fat over there at Facebook, okay? Why is this? Well, average revenue continues to increase for Facebook. And if you look at this on a worldwide basis, it's increasing. US and Canada, it's increasing. Europe, it's increasing. Asia Pacific, it's increasing. Rest of the world, it's increasing. And why is this? Why is average revenue per user continuing to climb? Well, because more and more advertisers are coming onto the platform and they're spending more and more money, and there's only so much time that you and I have to scroll Instagram and Facebook and the different platforms. So which means advertisers, to get in front of our face to advertise to, they have to pay more and more and more. If you look at something like Google, right? Average cost per click on Google is like $2. And that number used to be like 5 to 10 cents. Like back in the day, you used to be able to get Google clicks for less than a quarter, okay? And now they're like $2. And that's just what happens over time. These things get more and more expensive. Big companies come on, they spend more and more money. And guess what? That ends up driving up ad rates, which also ends up driving up profitability of companies like a Google, or in this case, obviously Facebook. And so when I look at Facebook as the easiest money in the stock market. And I know some people have some agendas out there and they're like, Facebook's bad or whatever. And let me just tell you, you've lived a very sheltered life if you think like Facebook is the worst business model, because I can think of about 50 business models that are far worse than Facebook. And I could actually go through and make any company look bad if I wanted to. So regardless of what your personal opinion is on Facebook, you got to look at this stock and realize like this is some of the easiest money that can be made in the stock market, in my opinion. That's why I'll continue to buy Facebook here in January 2020 and probably throughout the year, as long as it stays around where the stock is now, okay? Stock number 2 up here is Toll Brothers, ticker symbol TOL. It's actually a stock I used to be in, and then I sold out of the position, and now I'm interested in the stock once again. And this isn't some super fast growing company. It's actually a slower grower than the other 2 companies. The first one being Facebook, obviously, that's a pretty good grower there. And then the third stock we're gonna be talking about is a super insane fast grower. So Toll Brothers is like the conservative one of the bunch, okay? It's a $39 stock. They're a luxury home builder, but I'm not talking about like super mega custom mansions or something like that. But they're really catering to like the top 20% of income earners out there. That's Toll Brothers customers at the end of the day. That's who they're selling homes to. The top 20% of income earners really out there, or the top 20% of the wealthy, I guess you could say. And this is an all United States focused business. I'm just gonna show you a couple pictures of the homes so you can kind of see the designs and kind of how they do these different types of homes. They're kind of like a trendsetter in like what's the new wave when it comes to like building homes. They're like really a trendsetter, and all the smaller builders, they all end up following suit and trying to figure out, okay, Toll Brothers is doing this on those homes that sell for $1 million over there. What can we do that's somewhat similar where we can sell a home for $500,000? And Toll Brothers is kind of always a trendsetter, and they're kind of setting the new trends and when it comes to homes a lot of times, and then everybody kind of follows suit behind them, okay? This is a company that builds homes all over the United States of America, and they're in all the markets you want to be in, okay? Charlotte, I used to live in Charlotte, North Carolina, Raleigh, North Carolina, Greensville, South Carolina, okay? ATL, Dallas, Austin, Houston, Denver, Salt Lake City, Phoenix, in my city, Las Vegas. These are the places you want to be if you're a home builder, because these are places where lots of folks are moving to, and they're moving from other states to move here. And when you have that type of action, you have more and more folks looking for new homes rather than maybe a used existing home, especially if they have money. And keep in mind, once again, Toll Brothers is going after that top 20% of income earners out there, okay? Now, they're also in the markets that might not be growth markets from a perspective of like people moving there, but people have a lot of money, okay? San Francisco, San Jose, Los Angeles, San Diego, Chicago, New York City, Miami. Those are mostly places that aren't seeing necessarily huge influxes of a ton of people moving to them, but in those markets, when you're a new builder and you're building these new modern homes, a lot of folks in those markets might be living in an existing home that's, well outdated, let's say, but those people have good money, and so they look and they say, wow, that Toll Brothers is building that nice community over there. Maybe I want to go live there and get a really updated modern home. So that's another good thing. So Toll Brothers is everywhere you really want to be across the United States, whether you're talking markets with a lot of money or whether you're talking growing markets like my city, Las Vegas, or just in general. Now, in terms of who's buying these homes, well, 22% of the people that buy these homes are cash buyers. An average FICO score 762 on their homes, meaning essentially, once again, there's not as much risk with a lot of these Toll Brother buyers as there might be in the lower end, home buyers, I guess you can say. When you're selling $200,000 $100,000 new homes or $300,000 new homes, you can have a little more risk in there. But with Toll Brothers more on the higher end, a lot of cash buyers, a lot of great credit scores, you don't have to worry nearly as much about the buyers and cancellations or something like that as you might, like, let's say, you know, the $150,000 new home or $250,000 new home brackets that there's some of the other public companies that are home builders deal with. You know, the Toll Brothers just at a whole different level there, okay? They also have a nice land position now. They have over 59,000 lots, which as a home builder, how many lots you have is extremely, extremely important, because you could be building great homes and have great marketing, great brand and all sorts of things, but if you don't have the lots to put those homes on, like, you don't have anything. So they have more lots than they've ever had. That's obviously a good thing for the company. This is also a company that has been diversifying their product portfolio, okay? So if you go back to this company, you know, a couple decades ago, it was almost, you know, solely focused on like single family homes. And single family homes are still definitely the biggest part of their revenues, but now they have attached, age qualified, and city living that continue to build. So they're continuing to diversify the business model at Toll Brothers, and I definitely love to see that, okay? I'm not the biggest fan of looking at like book value per share, but I gotta tell you, it is great to see the book value per share being pretty dang close to the same exact price I'm paying per share for this stock, okay? Book value per share for Toll Brothers is about $36. And keep in mind, once again, Toll Brothers is about a $39 stock. So that makes me feel pretty comfortable. If I'm buying these shares, you know, even in the high 30s, I'm getting a pretty good price on a long-term perspective on this company. Forward P on this company is under 9, which is extremely low, okay? That's an extremely low forward P. And who knows, maybe if they have a little better year than expected, that forward P might end up being like a 7 or 8 or something like that, which is definitely possible. We know obviously the stock market's done well. If you're thinking about the higher end of the market, they pay attention to things like how the stock market's doing overall, what's going on with interest rates, things like that. Obviously, interest rates have been going down, stock market's been going up. A lot of the worries about could we have a 2020 recession have receded some. So if you're thinking about, you know, the person that's going to make a $1.3 million home purchase on a new Toll Brothers home, they're feeling definitely, I would say, much more confident than they would have, say, the same time last year. Because at the same time last year, there was a lot more worries about what might happen in 2019 going into 2020. And I could just say, if you're looking at confidence levels from people with money, I would say they're much more confident in what's going to transpire in 2020 than they were previously. Let's just put it that way, okay? Now, this one does pay a dividend, not a big dividend, like 1.1%, but their payout ratio is incredibly low, 10%. So the way I look at Toll Brothers at the end of the day, this is a phenomenally well-run home builder. In my opinion, the best run home builder out there. I'm getting a dividend stock here. Probably not going to get crazy stock price gains on this. This is not the type of stock that's going to, you know, go up 50% or 100% next year. At least in my opinion, it's all possible. Who knows? Maybe Toll Brothers has way better numbers than I ever expected, and maybe the stock does shoot up 50% over the next year, some crazy amount. But I'm not expecting that. The way I look at a Toll Brothers stock, I'm going to be able to get, you know, a 5 to 10% gain per year, another 1 to 2% on dividends, and it's just that consistent player in my portfolio in a company that should be able to raise their dividends much in the future. And when I go into 2020, I'm a little more focused on dividends. I don't want to just be buying growth stocks. I want to be buying some of these dividend payers that could increase dividends dramatically over the future years. And look at Toll Brothers, 10% payout ratio. That's incredibly low, okay? That was stock number 2, Toll Brothers. Let's get into stock number 3. It is Beyond Meat. Now, I gotta say with this one, once again, ticker symbol BYND on this one. This is a stock I'm approaching with caution, okay? So this is no stock that I'm gonna be flooding money into in January of 2020. I can guarantee you that, but I'm gonna likely nibble off a few shares, okay? Right now, this is a stock that's about $74 a share. Once again, their ticker symbol is BYND. They're somewhat of a new company out there, and basically, they got proprietary science on how they're redefining meat. And I'll probably show you the slide somewhere here as I'm talking, but essentially, let me explain it to you in the most simple terms, okay? Beyond Meat is trying to make products that taste like meat and have like the same type of texture as a meat. So if you buy a burger from Beyond Meat, it's supposed to be somewhat like a ground beef burger or something like that. If you buy a Beyond Meat sausage, it should taste and have the same texture or something similar to like a regular sausage or something like that. So they're trying to go more plant-based, and it's for people that want to go more on a plant-based diet than like, you know, traditional meat diet or something like that, okay? This is the first time I've been capitalizing on like a changing trend in diets. Although I will say this is the biggest change, and this is one that's not ending anytime soon in my personal opinion, plant-based diets, okay? But I capitalized on Whole Foods. They were obviously an organic grocer that was totally focused on like organic products and those sorts of things well before they were ever acquired by Amazon. I owned Whole Foods stock, and I was able to capitalize on that move to like organic and organic groceries and whatnot, which was a change in like how users bought foods and stuff. I was also able to capitalize on another company named Annie's Homegrown. And this was a company that I unfortunately only made a little bit of money on. I should have made a lot more because General Mills ended up buying them out for like a 30-something% premium or something. And I'd already sold out of stock, but that was another one that was like organic products and whatnot. So whenever you're looking at like changes in how people's diets are going and whatnot, I was able to definitely capitalize on that whole organic trend. And the next one that's coming up is obviously the plant-based diet. And this is a diet that I don't think is going anywhere. I think this is going to get bigger and bigger over time. I don't think it's going to be something that takes over the world and no one eats meat overnight or something like that. I think that's completely unrealistic. But do I think plant-based diet is just a trend or just going to be here for like the next year or something? In my personal opinion, absolutely not. This is going to be something that continues to go on. And a lot of people think, well, what's the point of going on a plant-based diet? They're like, what, do you just not want to kill animals or something like that? And that's what goes through some people's mind. I can tell you that's actually the least reason of the bunch, okay? The main reasons that most people are going on a plant-based diet has to do with health reasons. A lot of what we had been taught, and when it comes up to like nutrition and whatnot, a lot of it was false. And as you do more digging and a lot of this information kind of comes up, you find that like a meat product in general is a really inefficient product. And when you look at a lot of the studies they're doing, it's really intriguing on you know, what changes positive can happen with a more of a plant-based diet rather than like a meat dominant diet or something like that, okay? So that's the main reason most people are doing. Also, a lot of people are doing it for climate change reasons. From what I've seen from a lot of different studies, over 25% of global greenhouse gas emissions are driven by livestock rearing and processing, okay? Also, 78% of all agricultural land is used for livestock, including grazing land and cropland dedicated to the production of feed, because it's unbelievable how much like just an animal has to eat just to be able to produce actually a little meat. Like, it's absolutely insane. And so I think those are really actually the two main reasons why more and more people are going to this plant-based diet. They're realizing there's actually some health benefits there, and they're also thinking about like climate change and some of those sorts of things. And so it's a whole like wave that I don't think is going to go anywhere, and I think it's going to get much, much bigger over the next decade or two. Although I will say, like, if you think everybody's going to stop eating steaks and chicken tomorrow, you're sorely dreaming. I think over time, just people might eat those things less. And instead of eating those things, let's say 5 to 7 nights a week, maybe they go down to 3 to 4, maybe 2 to 4 or something like that, okay? And then obviously you'll have the people that go full scale, okay? Now, in terms of Beyond Meat, they're spending more and more money on research and development as a percent of revenue by far versus their competitors. You look at a company like I used to own about a decade ago, used to be good dividend stock for me like 10 years ago, okay? Conagra Foods, they spend 0.6% of their net revenues on research and development. You look at someone like Tyson Foods, they spend 0.3% of their net revenues on research and development. So if you're thinking about who's going to innovate the fastest in this and who's going to, you know, continue to innovate and maybe take over when it comes to making these plant-based protein products, a lot of it could end up being Beyond Meat continue to take over, because this is a company that's just much more focused on research and development technology than a lot of these old cats like a Conagra Foods or Tyson Foods or Kraft Heinz or some of those different companies. So that's really intriguing because they can get into more and more product categories, and with this very strong brand they have, they can continue to expand into different categories, okay? Now you look at this company, it's extremely fast growth. I mean, and when I say extremely, I mean with a capital E. There aren't many public companies you'll ever find that have these type of growth rates, okay? 2017 to 2018, it's a company that grew 170% revenues year over year. Now that growth has accelerated. Yes, it's accelerated with a capital A, okay? Accelerated. So you're looking at 2018 year to date, the company had done about $56 million in revenue. This year, nearly $200 million year to date for revenues for Beyond Meat. That's 253% growth. So this company's growth rate has accelerated. And once again, you're not going to find many public companies that have those type of ridiculous growth rates like a Beyond Meat does. Like, that's just insane, okay? In terms of their total points of distribution, that is up 93% worldwide. Brand awareness is up over 100% year on year. If you look at their retail revenues, okay, from 37 million in 2018 year to date, now they're over 104. That's a little less than a triple up there, okay? okay? Restaurant and food service, from less than 20 million in 2018 year to date to 95 million in 2019 year to date. That's about a 5x there, okay? And they're continuing to do some expansion around the world. So you're looking at this business, it's growing ridiculously fast, like ridiculously fast. And gross margins have come up quite substantially. So if you go back to Q3 of 2018, they had gross margin percent of about 19%. Not that impressive. But if you fast forward to Q3 2019, you had a gross margin of 35.6%. Huge increase there, needless to say, okay? You look at the evolution of quarterly revenues. It's a company that has 10x revenues in a 2-year span. So if you go back to look at Q3 of 2017 to Q3 2019, literally it's a 10x in 2 years. Unbelievable, okay? But there's some bad with this stock, okay? And this is why I'm approaching this one with caution. There's 2 reasons why I'm approaching the stock with caution. The first one is the forward P is nearly 200. And I will say that's a ridiculously high forward P, but I will say, like, how many companies have this type of ridiculous growth rate? So you can expect a ridiculous forward P of almost 200 when you have those type of ridiculous growth rates. When you look at something like a Facebook at a 22 forward P, when you look at something like a Toll Brothers at less than a 9 forward P, and you look at a Beyond Meat at 195 forward P, it just looks literally ridiculous. It looks like that's insane. But you can't really compare it to those type of companies like a Facebook or Toll Brothers because the growth rates are substantially different. Keep in mind, Beyond Meat just grew revenues 253% year over year and has 10x revenues in the last 2 years. You can't say the same for a company like a Toll Brothers or Facebook. So I'm kind of buying these companies obviously for different reasons, and Beyond Meat's that insane growth one, okay? But I got to approach it with caution. The other reason I have to approach this stock with caution is, although I like their CEO Ethan Brown there, okay, I like him. I like the guy. He's a new CEO to the public markets, and from what I have seen, he doesn't have any experience leading a publicly traded company. So between the valuation and between obviously a CEO with pretty much no public experience, I have to approach this one with caution, which means I start a little position, I nibble a little bit, hope for it to go down more on some volatility or some negativity out there or some bearish points or something like that. Then I buy heavier and heavier as it goes down. And who knows, maybe that doesn't happen. Maybe I start buying into the stock in January 2020, I nibble off some shares, and then it just starts going up to the moon. It's definitely possible, but sometimes in these situations with these volatile stocks, it doesn't really work that way. A lot of times they'll shoot too much to the upside or too much to the downside in a particular time. And in this stock in the past, shot way too much to the upside. Like this stock just a few months ago was a $200+ stock per share, which was absolutely insane. And if that stock was still at that price, it would have put its forward P at like 500 something right now, which is way too crazy. But anyways, guys, I hope you enjoyed this video. As always, let me know what you think about these 3 stocks in that comment section. Make sure you smash the thumbs up button if you enjoyed today's video. Don't forget, if you want to join my private group and learn directly from me, this is a chance of a lifetime to get in there. Check out the pinned comment down there and go ahead and join us in there. And I look forward to having you guys as part of the group. Thank you for watching and have a great day.